A futures contract is a legally binding agreement to buy or sell a specific quantity of a commodity or financial instrument at a future date and price. To understand why firms and individuals trade futures, let's look at the several applications of futures contracts, the basic pieces that make up a contract, and the accompanying costs involved in trading futures. Futures contracts help organizations and people manage risk and uncertainty. In a dynamic market where prices are continually changing, futures contracts allow you to lock in a fixed price for purchasing or selling at a later date. Businesses and consumers can limit the possible negative impact of price changes by locking in a set price. Consider the coffee business as an example to demonstrate this principle. When the price of coffee beans decreases, it benefits coffee shops but poses challenges for coffee farmers. Conversely, if the price of coffee beans rises, the situation reverses. However, coffee bean futures offer a solution where both coffee producers and users can proactively secure prices in advance. By utilizing coffee bean futures contracts, individuals and businesses in the coffee industry can effectively lock in prices ahead of time regardless of whether the market prices rise or fall. Similarly, individuals can employ futures contracts to manage risks in their personal endeavors. For instance, if someone intends to purchase a new home in a year and anticipates a rise in interest rates that would elevate their mortgage payments, they can offset this potential increase by trading interest rate futures such as the 30-year US Treasury bond or 10-year Treasury note, depending on their time frame. Another purpose of futures contracts is speculative trading, where traders engage in predicting the price movements of various assets like commodities, currencies, or stock market indices. To illustrate, consider the price fluctuations of gold. A futures trader can potentially make profits by correctly speculating the direction in which the gold price will move. However, if the trader's predictions are incorrect, they may incur substantial losses, potentially exceeding their initial investment. Now that we understand the purpose of a futures contract, let's examine the 5 key components, also known as standard contract specifications. The first component is trading hours, which can vary for each futures market. While futures markets operate nearly 24 hours a day, 6 days a week, the specific trading hours differ depending on the product being traded. The second component is the tick size, which represents the minimum price increment by which a contract can fluctuate. Tick sizes vary across different contracts and are defined for each specific product. Contract size is the third component, and it remains constant for each commodity or financial instrument. For instance, one contract of crude oil always represents 1,000 barrels, while one contract of gold futures represents 100 troy ounces. The E-mini S&P 500 futures contract represents $50 multiplied by the price of the S&P 500 index. Contract value, also known as notional value, is another component. This is a commodity's current market value as represented by a futures contract. To determine this, multiply the contract size by the current price. The E-mini S&P 500 contract is $50 times the price of the index, as you have just learned. If the index is quoted at 2,250, the value of one E-mini contract would be $112,500. Lastly, there is the aspect of delivery. Futures contracts can be either financially settled or physically settled. Financially settled contracts expire into cash, while physically settled contracts expire into the physical commodity. For instance, the E-mini S&P 500 index future is financially settled, whereas crude oil futures are physically settled. However, in the case of physically settled contracts, individuals don't need to worry about the actual physical commodity being delivered to their doorstep. To understand the cost of trading a futures contract, let's consider an example using crude oil futures. Suppose the current price of a crude oil futures contract is $50 per barrel, making the total cost of 1,000 barrels $50,000. However, traders don't need to provide the full amount up front. Instead, they can control the $50,000 worth of crude oil with a relatively small deposit. This deposit is known as the initial margin requirement, which represents the minimum funds needed to enter into a futures contract. The specific initial margin requirement is determined by the exchange and can vary. In our example, let's assume that a trader needs to put up $3,000 in margin to purchase one crude oil futures contract, enabling them to control nearly $50,000 worth of oil. Futures contracts provide leverage, allowing traders to manage a greater underlying asset with a little amount of capital. Because of this leverage, even minor price fluctuations in the underlying asset can have a substantial influence on the futures contract. It's crucial to remember that while leverage has the potential for bigger returns, it also has the potential for significant losses. If losses become considerable, extra cash may be required to cover them. As a result, before engaging in futures trading, it is critical to broaden your investment education and knowledge. You now understand how to utilize futures contracts, what the contract specifications are, and how much a futures contract costs. If you want to understand more about futures, you should broaden your investing education before making any investments. Check out more of our award-winning investing education. Thanks for watching, and don't forget to like, subscribe, and hit the bell to get notified of future videos.